Hello and welcome to another video here at CAP2. As you probably know, CAP2 tries to understand economic activities in real time. We look at all kinds of data sets that are available in real time or near real time to understand all kinds of industrial activities, from mining activities to carbon emissions, industrial production, and so on. And today I would like to share with you our latest iteration of our carbon dashboard, of our carbon research, where we basically give our clients ideas on when to sell or buy, or when to hedge or not to hedge, to go short, depending on the needs of the specific clients. And just for you to get a better impression, I would basically now share the screen with our dashboard, where you can see that at first sight you see the real EUA price and its development of the fair value being the green line here, and the real price being the bluish line. We derive the fair price with an econometric model based on different kinds of inputs like gas storage, shipping choke points, and traffic going on at shipping choke points. We look at ports. We look at shipping traffic at ports, but also at the export and import structure of goods, because that also gives us an idea on the current and future carbon emission amount. So that's also relevant in understanding carbon price dynamics. At the same time, we look at all kinds of coal statistics. We look at the electric grid, at steel and cement plants. When it comes to steel and cement plants, we work with infrared satellites. So we, at the end of the day, look at the infrared radiation, the infrared signature that comes from European cement plants and steel plants, to get an impression of the capacity utilization of those plants, which again gives us a very good idea on not only current production, but also current and near future demand for additional EUAs. And as a client, you have access to two different kinds of signals. First of all, we have a hedge signal, which is basically tailor-made for asset managers who want to create performance by buying or selling EUA futures, or by going long or going short EUA futures. And at the same time, we have another signal we call it an opportunistic timing signal, that's basically tailored towards companies in the real industry, companies that have to comply with the ETS, companies that have to buy and cancel EUAs in order to be able to emit. And those companies, of course, want to optimize their timing when it comes to purchases of EUAs, but sometimes also they want to optimize selling of EUA positions. And this is an opportunistic signal. This is not about creating performance as an asset manager, but this is about trying to find a good moment when to buy or sell. And maybe we just take a quick look at those signals, starting with the historic track record of our hedge signal, which actually worked quite well in the last couple of years. This signal is basically based on three separate input factors. The first one being, we call it a general environment signal. This is about looking at, as I told you, gas storage, infrared radiation of steel plants, cement plants, choke points, information on the electric load in the grid, energy mix, that kind of information. And this is rather descriptive. This is not so much econometric. So doesn't really work like a black box. When infrared radiation goes up, that would actually basically mean for itself that it's more likely that prices will go up. If the load in the electric grid goes down, and if the energy mix tends towards solar and wind power, at that moment in time, of course, that would lead to a falling signal for our general environment signal. But at the same time, we also analyze the fair value. And in that case, we look at the trend of the fair value. And another 25% of the overall weight is driven by the current deviation from the fair value. So we have a fair value model, and whenever the real price seems to be highly undervalued or highly overvalued relative to our fair price as we see it and as we calculate it, then it's more likely that our overall hedge signal will react to that. Those three subcomponents also can be seen in charts, so you can better understand how they are working individually. Also at the current point in time, you can see what kind of subsignal shows what kind of signal, what kind of direction. For example, the current general environment signal would go long on EUAs. The trend signal, when it comes to the fair value, would also say, okay, you need to go long. And only our model that shows the current deviation from fair value, that model would actually for itself go short. But if you combine those three models, then you would end up in a long position, which of course also was a good positioning in the last couple of days and weeks. But at the same time, as I said, we have this opportunistic signal tailor-made for clients in the industrial area that need to optimize their purchase positions or purchase decisions when they have to buy and then later on cancel EUAs. And this signal at the end of the day is also based on dynamics in the current environment, in the trend of the fair value, and in deviations from the fair value, but they're interpreted in a slightly different manner so that we can identify situations where you can say with rather high likelihood that it's very sensible to buy or sell because all of those numbers all in all align towards a situation where it's very likely that in the next couple of days and weeks prices will go up, and in that case you would get an opportunistic buy signal because from that point on it's more likely that there will become some kind of mean reversion, for example, and at the same time we have an opportunistic sell signal that would identify moments where it's advisable to sell positions because it's not so likely that in the near future prices will keep on rising. So we are basically here looking for local tops, and in this case we are looking for local bottoming out situations where prices tend to go up after having reached that moment. And we are pretty sure actually that this kind of research is unique because it's being updated every day. Every day you are able to look at those signals. Every day you are able to look at the fair value, the trend of the fair value, deviations between trend and price. And if you want to, you can also dig into the raw underlying data. For example, if you want to know, okay, what's the infrared signature of European cement plants? Believe it or not, that also, is available in this dashboard. As we can see here, for example, when we go to yearly deviation analysis and go for the year 2026, right now we have basically 200 days in this year. 200 days have passed, and currently we have an infrared signature that is at the complete bottom of the historic distribution at this point of the year. You have a seasonal pattern, right? But within that seasonal pattern, the current numbers are very, very low, which means it's basically the interpretation of that looking at activity in the cement industry, in the European building industry at the end of the day. We have a rather mediocre environment, and that for itself is not supportive. But as you saw a couple of seconds ago, when it comes to the overall signal, that was positive. So even though cement for itself has a negative trend, the overall general environment signal is quite okay. Actually, by the way, if you want to get an overview on the information concerning gas storage choke points and so on, we also have numbers here that show basically the carbon relevant information in those areas like shipping choke points, infrared cement, infrared steel. Steel is actually doing slightly okay in Europe. Coal also is, at least when it comes to the overall numbers, not at a very low level. This is kind of interesting. Overall industrial activity is pointing upwards in the last couple of days. We had a negative trend for the most of the time in 2026, but the last couple of days and weeks, they were positive. But this is actually very compatible when you compare this to other business cycle data, like, for example, the PMI indices. They also surprised slightly on the positive side. So this is also plausible, but we think those numbers actually leading many other business cycle indicators because they have a publication lag. They always look in the rear mirror, and here you can see what's happening more or less in real time. So we think this is actually a rather unique setup to understand price dynamics of the European EUA price. And we don't think actually that there's a lot of research out there that delivers that kind of information in such a compact manner. Thanks for listening, thanks for watching, and have a great day. Bye-bye.